Since it's already down, there is no lead up. There is no collection from the day before. So there is none of that sell off at the open. It's literally just going to be people wanting to get out. And there's a big difference because people wanting to get out can continue to drive it to the downside, where people that are collecting, that's just a quick sale, momentum up, drive up. This is different. This is everybody wants the hell out like this. So at the bell, I'm going to anticipate it's either going to go flat and then pull, or it's going to slightly drive up because people are going to be like, yay, this is a good spot. And then it's just going to probably knife drop until it finds support. And then look for stair steps, the usual. Yep. ISUN here too. There's some great opportunities for this. If you take a look, you can see it's coming up, VWAP coming up, VWAP up. See it?
Yeah.
Yep.
So some good scalping opportunities. If you look at this level, it's actually right here. Even though we had this tail, you can see support is right around this level. See it? It's here. It's here. It's here. Everybody see it? It's all here. This was the day of earnings, and this is why I always talk about straddling earnings. Let me mute these mics. This is why I always talk about straddling earnings, right? It was up here. This was after earnings. Look at this difference. Same thing with shop. So if you guys had straddled shop last night through the earnings, right here, right? Instead of playing those little lotto tickets, if you guys would have bought a call and a put, remember a straddle is the same expiration date and the same strike price, but all you're doing is you're buying a call. You make your money on the volatility. So if it super runs, now there's no stops, obviously, in the post market or the pre-market, meaning after hours or in the morning until the bell, there's no stop. So what you have to do is your call at the open, right, is going to get wrecked, but your put is going to make a lot of money. So ideally what you want is your call, let's say your call costed you $100, okay? Your call is going to go to zero, but your put is going to go to, $250, $260, $300 or whatever. It's going to make up the difference of what your call lost and profit from itself, because typically that's a 200 18 I've seen 1800% move just from earnings. So straddles are your friend through earnings. Don't I say that all the time?
Coach, what's the difference between a straddle and a strangle?
It's just the strike price and expirations can be different on a strangle. So the only difference is, remember, the only definition of a straddle is same strike, same expiration. Let's look at a strangle. With a strangle, let's say you have a bias to the downside, okay? Maybe you spend more money on a put. Let's say you buy a put 30 days out expiration, right? So you're invested in a put. Let's say you put $1,000 into that put, right? But you want to protect it a little bit to the upside. So maybe you go a week out on your call, right? We'll just do 1 week like a lotto. And instead of 1,000, maybe you only invest $100 on this side. Okay. So you got a little bit of protection, but you have a bearish, this is a bearish strangle setup, right? Because you're thinking more downside than up. Does that make sense?